Las Vegas grew rich on overnight transformations, casinos, convention halls, and dream houses built faster than anyone could count. But today, that same rapid growth is showing its cracks. Inventory has leapt, sales have slowed, and homeowners who once rode a boom now face uncertainty. In July alone, inventory jumps and months on market rose sharply, signaling a market that has cooled faster than almost any other big metro in America. This isn't a small wobble. It's a structural reset driven by unaffordable prices, cheaper renting alternatives, new short-term rental limits, and tourism headwinds that cut into incomes for thousands of local households. We'll unpack how these forces collided, why Las Vegas ranks among the most volatile large markets, what the math looks like for buyers and sellers, and how everyday Nevadans are feeling the impact.
Between 2019 and the post-pandemic high, median home values in Las Vegas shot up dramatically, a jump that pushed local incomes out of alignment with home prices. Today, less than 1 in 5 homes for sale is considered affordable to a household earning the local median income, a reality that shuts many first-time buyers out of the market and pushes them toward renting. Mortgage payments for a typical median-price house have been higher than the equivalent rent, making renting the rational short-term choice for price-squeezed locals. When buyers step back, turnover slows, and sellers face longer listings, lower sale-to-list ratios, and price concessions, conditions that flip the market in favor of patient buyers and strategic investors who can buy the wait.
Las Vegas's relationship with short-term rentals changed suddenly. County and municipal rules limited licenses, created distance rules, and capped density, a regulatory squeeze that prompted many would-be hosts and investors to put properties up for sale rather than gamble on restricted returns. At the same time, home builders answered prior demand with huge additions to supply. The post-pandemic building surge and expanded inventory combined to produce one of the largest inventory jumps in the country. A classic supply shock that, when demand softens, accelerates price cooling. Some sellers who once relied on short-term revenue now face long sales timelines and price adjustments, and the market has to absorb both speculative and new build supply simultaneously.
Las Vegas's economy is inseparable from tourism. When convention attendance and visitor counts fall, local wages and hospitality jobs wobble, and with them, housing demand. Recent reporting shows visitor numbers and convention attendance softened significantly in months where household incomes felt the squeeze, and that translated directly into fewer qualified buyers and more homes lingered for sale. Layered on top of these short-term forces is a long historical pattern. Las Vegas ranks among the most volatile large housing markets, with studies estimating a nearly 50% chance of a 5% price drop over a random purchase period, a volatility baked into cycles of speculation, tourism dependency, and fast supply swings.
Mortgage rates have been the invisible lever behind Las Vegas's housing swing. When rates fell, demand surged, and builders raced to supply. But rising yields and tighter borrower standards have since sapped buying power. Many prospective buyers who hope to refinance or stretch into a larger home find qualifying thresholds higher and monthly payments less palatable. Lenders now price in higher risk, down payment cushions are larger, and adjustable rate exposures make some owners vulnerable when resets occur. The net effect, a slower pool of qualified bidders, longer negotiations, and pressure on sale prices, especially on properties that were priced for the low-rate era rather than today's cost of credit reality.
Investors historically padded Las Vegas markets, some buying to flip, others to rent short-term to tourists. When policy, rates, and occupancy dynamics shifted, investor behavior shifted too. A subset of small-scale flippers pulled back, while larger institutional players and cash buyers selectively targeted undervalued pockets. That bifurcation matters. Smaller investors withdrawing removes quick arbitrage buyers who once kept prices buoyant after downturns, while larger capital can stabilize pockets but also deepen disparity by deploying cash offers that crowd out local buyers. The result is a market with uneven liquidity. Some neighborhoods still trade quickly to cash buyers, others sit longer waiting for traditional mortgage-financed purchasers.
Las Vegas is not a single market. It's dozens of micro-markets with different economics. Affordability erosion hits hardest in neighborhoods with stagnant wages and limited transit access. Conversely, suburbs with newer schools and work commutes that match growth corridors hold value better. The inventory glut is not uniform. Some older neighborhoods see longer days on market and deeper concessions, while newer master-planned communities still attract demand from buyers who can stretch. These disparities matter for social equity. Families in historically disadvantaged zip codes face longer recovery times and fewer cash buyer rescues, extending the pain of a market reset into years rather than months.
Local policy and infrastructure choices will shape whether Las Vegas weathers this reset or lingers in a slow correction. Zoning flexibility, transit investments, and incentives for affordable housing can rebalance supply toward what working households need. Conversely, strict short-term rental bans without transitional support can flood the market with supply and depress prices rapidly. Near-term outlooks show a market likely to remain soft until credit conditions ease or until tourism and local wages recover materially. For sellers, realism on price and time to sale is crucial. For buyers, understanding financing risk and neighborhood fundamentals will separate good buys from long waits. The decisions city leaders and developers take now will set the horizon for recovery.
When prices cool quickly and credit tightens, a quieter crisis can bubble beneath the surface. Homeowner stress. Many households that stretched to buy during the boom now face higher payments, stagnant wages, or rental market shocks if they'd relied on short-term income to service mortgages. For owners with variable rate products or thin equity cushions, a market that turns soft can quickly translate to constrained options, longer listings, lower offers, and in worst cases, the difficult calculus of handing keys back to the bank. The wealth effect that once buoyed local consumer spending starts to reverse. Less home equity withdrawal, fewer renovation projects, and weaker retail receipts that ripple through the local economy. That feedback loop lengthens recovery timelines and tightens budgets for ordinary families trying to stay afloat.
Businesses answered previous year's demand with tens of thousands of new units, single-family tracts, townhome projects, and apartment complexes, but the economics of construction have shifted. Rising input costs, lot price carry, and labor constraints pressured builder margins during the boom. Now, slower absorption forces repricing decisions and slowed starts on speculative parcels. Developers with deep land banks may weather a prolonged absorption period, pausing new phases to avoid flooding the resale market, while smaller regional builders risk insolvency if sales stall and costs remain high. The strategy shift is visible in permit activity and lot inventories. Earlier frenetic starts morph into staged deliveries and cautious phasing, which will determine the next wave of supply pressure in Las Vegas suburbs.
As the market cools, creative solutions emerge that can protect households and bridge affordability gaps. Shared equity programs, community land trusts, down payment assistance, and employer-assisted housing are part of a toolkit cities use to help working families move from renting to ownership without excessive leverage. On the financing side, smaller lenders and credit unions sometimes offer targeted products, thin credit mortgage programs, graduated payment plans, and subsidized mortgage insurance that can expand buyer pools responsibly. Public-private partnerships that blend subsidies with developer incentives can produce mixed-income projects that stabilize neighborhoods while preserving asset growth for owners. These approaches aren't silver bullets, but they can moderate the human cost of a market reset if implemented at scale.
For buyers who choose to act in a softer Las Vegas market, a clear playbook helps separate opportunistic buys from pitfalls. First, get pre-qualified by a reputable lender and model total monthly costs under several rate scenarios. Budget for stress tests, not just the current payment. Second, focus on neighborhood fundamentals, employment access, school quality, and transit over headline price drops that may be localized. Third, evaluate seller flexibility and time to close. Patient buyers can negotiate inspections, repairs, and financing windows to uncover value. Finally, treat long-term resilience as the anchor. Consider resale pathways, rental demand, and whether the property could withstand future rate shocks. In a market with volatility baked into its DNA, disciplined underwriting and neighborhood-level analysis are the strongest risk controls.
As ownership becomes less attainable for many locals, rental markets bear the strain. But Las Vegas's rental landscape is changing fast. Short-term rental conversions, pandemic-era moves, and investor-owned single-family rentals increased supply in some segments, while affordable long-term units remain scarce. That mismatch raises two painful realities. First, lower-income renters face higher eviction risk when wages falter or when landlords sell to cash buyers. Second, rent-burdened households cut discretionary spending, further compressing local retail and service incomes. Eviction filings, emergency shelter use, and requests for rental assistance are early barometers to watch. They signal human stress that pure inventory charts can miss. Policymakers who target tenant protections and renter assistance programs can blunt the worst of these impacts, but timing and scale matter.
Housing is the lever behind much local commerce. When homeowners feel wealthier, they renovate, buy cars, and spend on local services. When equity drains and uncertainty rises, spending contracts, and small businesses feel it first. Las Vegas's dependence on hospitality magnifies this effect. Slower home sales reduce demand for furnishings, contractors, and neighborhood retail, while weakened tourist flows further compress service sector earnings. Municipal revenue streams, sales taxes, permit fees, and property tax timing can wobble, creating budgetary stress for public services precisely when demand for social safety nets increases. Watching retail vacancy rates, contractor backlogs, and sales tax trajectories gives a fuller picture of how a housing reset ripples through the city's economic engine.
A data-first approach separates noise from signal. Track these headline metrics weekly or monthly. Inventory levels and months of supply. Median days on market. Sale to list price ratios. Mortgage application trends. Permit starts and eviction filings. For Las Vegas specifically, add convention attendance and short-term occupancy rates to the dashboard. Their movements often precede shifts in qualified buyer pools. Together, they create a dashboard that tells a layered story. Supply growth without matching buyer demand, rising days on market, and weakening sale-to-list ratios are an early warning. A rebound in mortgage applications, firming occupancy, and stabilizing permits are signs of recovery. Present these metrics as a living dashboard in your video, updated with callouts when any trend crosses risk thresholds.
Sellers face a two-sided choice: price aggressively to sell quickly or hold for an uncertain rebound. The middle path, realistic pricing with targeted pre-listing improvements, often yields the best outcomes in a cooling market. Small fixes that improve perceived value, kitchen hardware, paint, curb appeal, outperform expensive renovations that buyers won't fully credit. Price with a clear negotiation buffer. Optimize days on market targets with staged open houses, and be transparent about rental history or short-term income expectations when relevant. Finally, if short-term rental revenue powered your purchase, present conservatively under due diligence to avoid deals collapsing on financing contingencies. Sellers who plan for time and negotiation typically avoid fire sale discounts and keep more of their equity intact.
Housing dynamics are inseparable from where people work and how they commute. Las Vegas's labor market, heavily weighted to hospitality, retail, and construction, saw unusual shifts during and after the pandemic as remote work patterns, gig economy jobs, and changing convention schedules altered daily commutes and employment stability. Neighborhoods within easy access to major employment corridors or transit lines have shown relative resilience, while areas with long commutes experienced both slowed buyer demand and elevated turnover. Workforce housing shortages near new job centers create friction. Employers struggle to attract staff when affordable, nearby options are scarce, which in turn suppresses hiring or forces wage premiums that firms may not sustain. Ultimately, commuting realities and employer location choices are critical levers for both housing demand and neighborhood recovery.
Long-term housing resilience in Las Vegas must contend with environmental limits, water availability, heat, and resilience to extreme events shape the livability and cost of maintaining homes. Development on the urban fringe increases reliance on water imports and longer infrastructure runs, costs that ultimately flow to homeowners through utilities, fees, or higher maintenance budgets. Heat-driven energy demand also raises operating costs for households, and insurance exposures can shift with climate patterns. These are slow-moving but crucial economic factors. Buyers and planners who ignore water stress and climate vulnerability risk underestimating true holding costs and resale demand. Smart growth that couples water-wise landscaping, energy-efficient building standards, and clustered development can reduce risk and support long-term market durability. For investors, Las Vegas presents a study in contrasts. Volatility creates opportunities for disciplined buyers, while posing pronounced risks for speculators. Short-term windows open when inventory spikes intersect with financing dislocation, yielding selective bargain buys in stable neighborhoods with strong fundamentals. But pockets of risk are real. Oversupplied submarkets, properties dependent on short-term rental income, and homes with weak transit access or climate vulnerabilities can underperform for years. Active investors that combine neighborhood-level due diligence, conservative leverage, and a plan for either stable rental demand or resale can find attractive returns. Those chasing headline discounts without these guardrails can find themselves holding illiquid assets. Timing matters, not for frantic flipping, but for patient, data-driven deployment of capital.
Las Vegas's housing story is neither a single sentence nor a simple headline. It's a complex, layered narrative of affordability pressure, policy shifts, investor behavior, and regional vulnerabilities. The market's rapid cooling reflects real economic trade-offs. Buyers constrained by higher rates, sellers adjusting expectations, and communities facing uneven impacts. Yet there are levers for resilience: policy choices, targeted affordability tools, infrastructure alignment, and disciplined capital that can shorten recovery and limit human cost. If you're a buyer, seller, investor, or policymaker, the path forward is the same. Prioritize fundamentals, stress test scenarios, and plan for resilience. Subscribe for regular real estate updates and join the conversation, because how Las Vegas navigates this moment will offer lessons for many fast-growing cities that followed similar boom time paths.